The market, just like a broken record, keeps repeating itself. Everybody's favorite beverage breaks out. Stay tuned. We'll discuss this and much more. Hello, this is Michael Loftus for Wealth and Wisdom TV, where education is the key to a successful financial future. First up, don't forget there is a button over here, show more for additional information and links to articles, etc. on today's video. Also, if you're looking for a different opinion other than Wall Street and the talking heads on TV, please do consider subscribing. First up, we have the numbers, week ending 5-4 and pretty much sideways once again. So let's go to the big charts. Well, like we said, pretty much a sideways market, actually on the downside, until a certain investor bought a certain stock and the market surged on Friday. Now, even though this purchase was done well over 6 months ago, it did in fact move the market. So why is the market like a broken record? Because I feel like I keep repeating myself. Guess what? We bounced off the 200-day moving average, and on the top we found resistance. Same old, same old. So for the 7th time this year, 4th in the last month, we bounced off the 200-day moving average. The bulls like that, the bears do not like that. We did go above the 20-day moving average just by a little bit, and we still have some pretty serious upside resistance with your 50-day and 100-day moving average. Now at the bottom of the chart, volatility. Again, last week, we broke down there, now sitting in the 14, so that does tell you a little bit of something there. Not a lot of volatility in this market, but at the top, relative strength, again, there is none. We're just sitting there on that 50, not doing much of anything. And then momentum of the market, again, really very limited momentum. So here is a new chart. Okay, we brought this in this weekend. I was working on this, and it kind of shows you our run up there, nice uptrend, hit our highs, and then, of course, we've seen a series of lower highs. Now, we have what's forming is a symmetrical triangle, and normally in these circumstances, you'll get 3 lows. Now, we see the one definitive, because you go 1, 2 to the top, 3, 4, and 5, well, not quite. So I think we're still going to hit again on the bottom of that, but you can see it will come together. So pretty much mixed signals here on the short term. As we say, we don't make a lot of moves on short term, but as you'll see by this chart, our signals are negative, but PMO signals positive, so really neutral. So for new money, just waiting, being patient, looking for opportunity. And then existing monies in the market, we're not making any changes, but we're going to say positive on the short term right now. Next up, weekly view, which is going to give us more of a midterm view. No change here. And as you see, there's your bullish uptrend from your 15-16 low. We've broken below the trend line there. Not a good sign. Failed, trying to go above it. And then our 2 signals on the bottom there, MACD and PMO, both show negative, so midterm view right now continues to be negative. Next up, monthly view. Yes, very much a bullish trend, and as you can see, we're going to say that this is in fact positive. The only thing concerning, you can see it with a zoom in there, is the button hook pointing down on momentum. If we get a crossover on our long-term chart, we might be looking at removing some equities from our portfolios, but to be determined. Market breadth didn't show this last week. Quick update. Pretty much the same. Again, if you're above 60, we're in a bullish mode. Below 40 is bearish. Here is the 200-day. So those companies above or below the 200-day moving average, pretty much the mixed bag, but nobody above 60. Then we look at a shorter term view. our 50-day moving average. And as you can see, again, mixed. 49 for the S&P, 42 for the NASDAQ, mids 50s, smalls the only one that have a little bit of life right now at 57%. So that means 57% of the companies in the small caps are above their 50-day moving average. Let's get to the sectors. Ongoing, showing this chart, this represents 76% of the S&P. You've got technology being the largest holder with 25%. So across the board, everybody was down except the NASDAQ, and that was based on that one push at the end of the week. So, bringing all this together, U.S. equities, only 3 of 11 are in an uptrend. That's down from 8. So we're now in a downtrend on our U.S. equities. International, 8 of 53 in an uptrend. That's down from 16. So again, down as a group. So that's concerning. Not seeing a lot in the market as far as being able to push it higher. Here's a new section, Tweets of the Week. So here is a tweet from Odd Stats, and yes, he brings us some odd stats. Apparently a former analyst, don't have his bio or photo, he doesn't show that, but puts out great information. He says, did you realize we're in the 6th longest S&P uptrend since 1950? Pretty good. Here's how S&P did once the uptrend finally ended, meaning the 200-day moving average was lower than the day before. Oddly, 100 days later, 2 events were up, 11%, 3 were down. So, really mixed bag here, but interesting statistics. Next up, Mark Yusko, hopefully I'm saying that correct. Analyst, great, really funny, quirky, but always good information. World's greatest indicator, still saying cash is king. It has been since the first week of February. It's basically the S&P 100% of stocks above the 200-day moving average. Last but not least, one of our favorite follows, Danielle Martino Booth. I've spoken about her in the past. Great book called Fed Up. It is a must-read. Link below if you'd like it. Also, what she did was she does have a paid subscribership. Here's her first report in the year that's not paid. Really good information. She used to work at the Fed. And one of the quotes here, today's bubble is in central bank balance sheet and the massive monetary inflation that's created oceans of liquidity. Link below, great read, take a few minutes. Next, we're going to talk about treasuries, spreads, 10s, -2 years, and once again, we go lower. 0.44, getting closer to that inverted yield. We'll continue to watch that. Do have concerns about that as well. So, on my radar. Last week, we talked a lot about commodities. One of our viewers asked, hey, what about coffee? Yes, coffee, here's a daily view, is breaking out as well. So, really good for the markets. Maybe not so much in the supermarket, but coffee is in fact breaking out. Haven't done anything here yet. Here's your weekly view. Had a failed breakout, went above that trend line and failed. So let's see what happens there. And there are different ways that you can, in fact, buy coffee, meaning in the markets. Next up, semiconductors, been showing this. Been a few weeks here. Here's your trend line on a weekly basis. Broke through, not looking too good. On the short term, again, we have a series of lower highs. So still waiting on this sector to break out before I make any moves here. Lastly here, what keeps me up at night? So, historical economic recoveries averages 41 months. Here, as you see, our most recent, the one we're now, 106 months. Pretty long. Here is a view that shows you the same information, but what happens on the correction side after a recovery. And this is from Lance Roberts. Again, another really good follow on Twitter. And here I continue to show this. The S&P, and then we have the CAPE, cyclically adjusted price earnings, and it shows where we are today. And if we were to get back just to 20 CAPE, because we're at 31, that would represent a loss of 16.9%. 15 CAPE, which is fair value, normal, long-term, okay, that would be a loss of 38, and 10, which would be oversold, would be a loss of 58. Not saying it's coming, but saying that we're still overbought despite this recent volatility. Wrapping things up, fear and greed, no movement, but still sitting on the fear side at 40. So again, our indicators, short-term positive, mid-term negative, long-term positive, together we're neutral. As always, thank you so much for watching. This is Michael Loftus for Wealth and Wisdom TV.